Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our series on the set of videos on reading the financial statements 2 of 7, balance sheet 2 of 2. Hope you will like, share and special request to all to don't forget to subscribe our channel. Series on reading the financial statements 2 of 7, balance sheet 2 of 2. Land. Land is a fixed asset and is placed on the balance sheet at cost. The cost is not adjusted for changes in value. So a property bought in 1980, say for $500 per acre, will still be on the balance sheet today for US $500, even though the market value may be a whopping US 200,000. This means that the value of land on the balance sheet may have significant more value than is reflected on the balance sheet. Note here that the land is not depreciated over time. Building equipment fixtures. This category includes buildings, warehouses, machinery, vehicles, furniture, equipment, and other tangible items needed to operate the business. Tangible items means the items which can be seen from the naked eye. These assets are placed on the balance sheet at cost. A contra account is to be made here by the name accumulated depreciation, and the amount will be the reflect of the loss of life of the equipment due to wear and tear. The depreciation rate is likely different for various classes of equipment listed in this account. This contra account is an accumulation of all of the various depreciation amounts. Using the matching principle, the period of depreciation should closely match the useful life of the equipment. The contra account increases during each period, which results in a net reduction in various fixed assets. Several methods are available to depreciate the value of equipment. All the depreciation methods have been explained in our videos on depreciation. Other fixed assets. These are not shown on balance sheet, but other assets that are sometimes found on balance sheets includes deferred charges and intangible assets. Deferred charges are similar to prepaid expenses but are not current assets and are expenses that are recovered over a longer period, greater than 1 year, that is, of course, whereas intangible assets such as goodwill, trademarks, patents, and copyrights are the example of the fixed assets. Liabilities. Like assets, liabilities are divided into current liabilities and long-term liabilities. Current liabilities include accounts payable, notes payable, accrued expenses, taxes payable, interest payable, and the current portion of any long-term debt. Long-term liabilities include long-term debt and other non-current liabilities. In any asset or liabilities, short-term is a period less than 1 year, whereas the long-term is a period greater than 1 year. Accounts payable. In the normal course of business, the company will owe vendors money. We don't often think of the local electric company the phone company and the gas company as creditors, but since they provide a service and are paid after the product or service is consumed, they are a creditor. Material suppliers and anyone who sells the business goods and services on credit are creditors. The amounts owed to the creditors are recorded on the balance sheet as a liability in accounts payable. Here, we have to note that there are two payables, the accounts payable and the trade payables. Accounts payable is including the local electric company, the phone company, or the gas company also as a creditor. But when you're talking about the trade payables, it just mentions all the trade creditors. That's the that's from where you are dealing the business. Notes payable. Short-term bank loans and temporary lines of credit that are due within 1 year are recorded in the notes payable account. Since the loan will most likely have an interest charge, there will also be an entry in the interest payable account. Accrued expenses. Under an accrual accounting system, some expenses are incurred before they are actually paid. Hours worked by the employee but not yet paid is an example of accrued expenses. Earned vacation credit and sick leave balances. So, in this case, as we have seen, in the accrued expenses, when the salary is already due, which will be normally be due on the 31st of or 31st or 30 or 31st of every month. But in not all the cases or all the companies, they pay actually on the 31st, but they may pay after the 1st of the month. So as on 31st of the date of the month, if you take in the balance sheet, then that will also be accounted as accrued expenses. Hours worked by employees but not yet paid is an example of accrued expenses. Earned vacation credit and sick leave balances are also accrued expenses of the company. Taxes payable. Taxes are another form of accrued expenses, but they are clearly shown in a separate category. Taxes payable for clarity. Usually, the decision to show taxes as a separate item from the regular accrued expenses is dependent on the amount of taxes owed. Interest payable. Interest on bank loans is another example of an accrued expense. Like taxes, interest is frequently lumped into one accrued expenses category. In our example, interest payable is broken out as a separate item. Current portion of long-term debt. The portion of a long-term debt that will be retired within 1 year should be reported as a current liability, along with the interest charges with a corresponding reduction in the long-term debt account. Long-term debt. Long-term debt is not a current liability, but it is a liability that may extend from more than 1 year to several years or over several reporting periods, as the case may be. This debt may be in the form of debentures or loans. A debenture is a long-term debt instrument. A debenture is not usually secured by any collateral such as property owned by the company, but instead is only backed by the creditworthiness of the company. One form of debenture is a bond. Mortgage is a secured loan since it is tied to some assets of the company. Shareholders' equity. Shareholders' equity is the owner's share of the company. In a stock, the owners are the stockholders. The ownership is reflected in the capital stock owned by the shareholders and the retained earnings of the company. Capital stock. The capital stock of the company may include common stock and preferred stock. Though there are many variations on how stock is issued, preferred stock looks somewhat like a bond in that the dividend is a fixed amount. But unlike interest on a bond, the dividends are not an obligation and are only disbursed when the company decides to declare a dividend. Also, unlike bonds, preferred stock does not have a maturity date. Retained earnings. When a company earns profits, it may either distribute the earnings to the shareholders in the form of dividends or reinvest the earnings back into the company. The profits that are not distributed as dividends are known as retained earnings. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share and subscribe our channel Accounts and Finance with FARSK. Thank you. Have a great day.